In the winter of 1934, a professor at Columbia Business School sat down to write a rule for handling money. He had watched a generation of savers destroyed, and he wanted to set out, in plain language, the single discipline that separated an investor from a gambler. 14 centuries before he lifted his pen, a body of commercial teaching far older than Wall Street, older than the banks, older than the very idea of a stock exchange, had already arrived at the same discipline. Two sources, different worlds, different languages, entirely different reasons for believing what they believed. And yet, when you set their conclusions side by side, they agree. Not loosely. Not by coincidence. Over the next 15 minutes, I want to show you exactly where they meet, why two traditions that never spoke to each other reached the same verdict, and why that agreement matters more to your results than any market forecast you will hear this year. Start with the professor. His name was Benjamin Graham, and to understand his rule, you have to understand what he lived through. Graham came of age in the markets of the 1920s, a decade of easy credit and easier promises, when ordinary people bought shares on borrowed money because everyone around them was getting rich and nobody wanted to be the one left out. Then came October 1929. The market did not simply fall, it collapsed, and it kept collapsing, and it took with it the savings of millions of people who had believed that a rising price was the same thing as a sound investment. Graham watched fortunes that had taken lifetimes to build vanish in weeks. And out of that wreckage, instead of bitterness, he drew a definition so precise it still governs serious investing today. An investment operation, he wrote, is one which, upon thorough analysis, promises safety of principal and an adequate return. Everything that fails that test is not investing. It is speculation. Graham had watched people buy shares purely in the hope that someone more optimistic would come along tomorrow and pay a higher price. He refused to dignify that with the word investment. He called it what it was, a wager on the mood of strangers. Graham gave the market a face. He called it Mr. Market, an obliging partner who turns up every single day and offers to buy your shares or sell you his at a price. Some days, Mr. Market is euphoric and names a silly high price. Other days, he is despondent and offers to sell you wonderful businesses for almost nothing. The mistake, Graham said, is to let Mr. Market's mood become your mood. He is there to serve you, not to guide you. When he is fearful, that is when you buy. When he is greedy, that is when you are careful. The whole discipline is refusing to catch his emotions. In his early years, Graham practiced what he called cigar butt investing. Find a discarded business the market has thrown away, so cheap that even one last puff of value remains, and take that free puff. It worked, but it was grinding, unglamorous work. And it set the stage for the student who would take the idea somewhere far greater. His antidote to an unpredictable future was an idea so simple it is almost always underestimated. The margin of safety. Pay meaningfully less than a business is actually worth. Not a little less. Meaningfully less. If you judge a company to be worth £1, do not pay 95 pence for it. Pay 60. Because here is what Graham understood that the crowd did not. You will be wrong. Not occasionally. Regularly. Your analysis will miss something, the world will change, the future will refuse to cooperate with your spreadsheet, and when that happens, the gap between the price you paid and the value you bought is the only thing standing between a mistake and a catastrophe. The margin of safety is not a clever trick for picking winners. It is a cushion for surviving your own errors. It is humility, expressed in numbers. Graham was not trying to be right more often than everyone else. He was trying to make sure that being wrong did not ruin him. His most famous student took that foundation and built something extraordinary on top of it. Warren Buffett absorbed Graham's discipline and added two ideas of his own, and both are about knowing your limits. The first is the circle of competence. Know what you genuinely understand, and stay inside it. Not what you could understand with enough effort, not what sounds impressive at a dinner party. What you actually, honestly grasp today. Because the expensive mistakes almost never happen in the middle of what you know. They happen at the edges, just outside the boundary of your real understanding, where confidence outruns knowledge. The second idea is temperament, and it is the one almost nobody can copy. The willingness to do nothing. To sit, sometimes for years, holding cash, watching others get rich around you, waiting for the right business to arrive at the right price. In a world that mistakes motion for progress, the ability to wait patiently is a genuine edge, because it is so rare. Buffett's first rule is famous: never lose money. His second rule is even better: never forget the first. Protect the downside, and the upside takes care of itself. Buffett's great evolution was to stop looking only for cheap businesses and start looking for wonderful ones. The turning point was a company called See's Candies. It was not statistically cheap in Graham's sense, but it had something the numbers could not see. A brand people loved, pricing power, customers who would pay a little more every year without complaint. Buffett bought it, and it poured out cash for decades. From that, he drew a lesson that reshaped everything. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. He began hunting for what he called moats, durable advantages that protect a business the way a moat protects a castle. A powerful brand, a network that strengthens as it grows, a cost advantage nobody can match. And he built Berkshire on an engine most people never notice: insurance. Insurers collect premiums today and pay claims years later, and in between they hold a river of other people's money, called float. Buffett used that float, patiently, to buy more wonderful businesses, and let the whole thing compound for over half a century. And then there is the matter of borrowed money, where Buffett is blunter than almost anywhere else. If you are smart, he has said, in effect, you do not need it, and if you are not smart, you should not be anywhere near it. Leverage is the one force that can turn a temporary setback into a permanent loss. A business with no debt can have a terrible year, wait, recover, and carry on. A business drowning in debt does not get that luxury. When the bad year comes, and it always comes, its creditors decide its future, not its owners. Now cross to the older source. Islamic commercial teaching rests on a small number of pillars, and the striking thing is how practical they are. The first is the prohibition of riba, money earning money purely through interest. The principle that wealth should come from owning and sharing in real productive activity, from taking genuine risk in a genuine enterprise. The second pillar is the avoidance of gharar, excessive uncertainty. Do not commit money to contracts whose outcome nobody can reasonably assess, and do not profit from another person's confusion. Close beside it sits the rejection of maisir, gambling, staking money on chance rather than enterprise, and over all of it sits stewardship. Wealth is held in trust, to be deployed carefully, productively, and with real accountability for where it goes. The older tradition is not merely a list of prohibitions. At its heart is a positive vision of how wealth should be made. It favors partnership. In an arrangement called mudaraba, one party provides the capital and another provides the skill and the labor, and they share the profit by agreement. And crucially, they share the loss too. In musharaka, partners pool capital and share both the risk and the reward together. The principle in both is the same. If you want the upside of an enterprise, you must stand in its risk. You cannot sit outside, lending at a fixed rate, guaranteed to be paid whether the venture thrives or fails. And this vision is not abstract. The man at the center of the tradition was himself a merchant before he was anything else, known throughout his city, long before any claim to privatehood, by a single title: Al-Amin, the trustworthy. In a world of sharp practice, his reputation was that he dealt honestly, kept his word, and never cheated a customer. Honest trade was not a compromise with faith, it was an expression of it. Set these two traditions side by side now, the Depression-era professor and the centuries-old teaching, and the alignment is genuinely difficult to dismiss. Take the first meeting point. Graham's margin of safety and the avoidance of gharar are, at their core, the same instinct wearing different clothes. One says demand a discount because the future is unknowable. The other says walk away entirely from arrangements built on unknowables. Both refuse to commit capital where the outcome is a guess dressed up as a plan. The second meeting point is the balance sheet, and here the overlap is almost uncanny. Buffett avoids heavily indebted companies because debt makes them fragile. The older tradition restricts interest-bearing debt as a matter of principle. Different roads, identical destination. When you run both filters over the market, they remove the same fragile companies, and what passes through both is the same kind of business, conservatively financed, generating real cash, built to survive a hard winter. The third meeting point is speculation itself. Both traditions look at money staked purely on price movement and reach precisely the same verdict. That is not ownership. It is a casino with better lighting. And both point toward the same alternative: the real economy. Real goods, real services, real cash flows. One arrives through decades of evidence, the other through principle, and they arrive at the same door. Now I want to be honest about where these two traditions genuinely part ways, because pretending they are identical would be its own kind of dishonesty. The motivations differ deeply. Graham and Buffett avoid leverage and speculation because those things lose money. The faith tradition avoids them because they are considered wrong, whether or not they happen to pay. One is a conclusion from experience, the other is a commitment held in advance of the results. The scope differs too. Value investing, in its pure form, has no forbidden industries. If the price is low enough, a distillery or a casino operator is simply a bargain. The ethical tradition says no. Some revenue is excluded whatever the price, because what a business does matters just as much as what it earns. And there is a third difference, perhaps the most important. One framework is a set of preferences, and preferences can be bent under pressure. The other is a commitment, and that is precisely why it holds when discipline is most expensive. So what does a modern values-first screen do with two traditions that agree? It runs every company through two gates. Gate 1 asks what the business does. Gate 2 asks what the business is. How is it financed? Could it survive a hard winter? Are the cash flows real? Does the price leave room to be wrong? Passing one gate is not enough. A company must clear both, and most do not. What survives is a short list that is ethically sound and financially resilient at the same time, and that belongs to anyone, of any background, who wants their money to stand for something and to stand up to stress. Let me make the two-gate screen concrete, because this is where philosophy becomes a decision you can actually make. Take a real company. Gate 1. What does it do? Where does the money genuinely come from? If a meaningful slice of its revenue flows from activities the older tradition will not sanction, gambling, interest, harmful products, it fails here, no matter how attractive the price. You do not even reach the second question. But say it passes. Now gate 2. What is it? Open the balance sheet. How much debt does it carry relative to what it owns? Would it survive if its revenue fell by a third for 2 years? Are its reported profits backed by real cash coming in the door, or are they an accounting story? And finally, at today's price, is there any margin of safety, any room for you to be wrong? Only a company that answers all of that well clears both gates. And when you run a whole market through this, the list that survives is short, often uncomfortably short. But every name on it is a business you can own with a clear conscience and a steady stomach, which is a rarer combination than the market would have you believe. There is one more thing these traditions quietly share, and it is the most powerful force in finance: compounding. Money that grows, and then the growth itself grows, and given enough time the curve turns almost vertical. But compounding has one absolute requirement: you must not interrupt it. A single catastrophic loss, a blow-up from too much leverage, one reckless bet gone wrong, resets the whole process to zero, and no rate of return can rescue you from a wipeout. This is why both traditions are so obsessed with what looks, on the surface, like caution. Avoid ruin, protect the downside, do not stake what you cannot afford to lose. It is not timidity, it is the deep understanding that the investor's real enemy is not missing a winner. It is the permanent loss that ends the game. Survive, stay disciplined, let the years do the work, and time becomes your greatest ally. Rush, overreach, borrow to hurry it along, and time becomes the very thing that destroys you. So step back and look at what we have. A professor scarred by the crash of 1929, working from evidence and hard experience, a body of teaching 14 centuries old, working from principle and conviction. They never met, they shared no language, no assumptions, no common world. Buy with a margin independently, the same house. Refuse what you cannot understand. Avoid the fragility that debt brings. Reject the casino for the real economy. Treat wealth as a responsibility, not a plaything. Where they differ, on forbidden industries, on preference against commitment, the difference only makes the ethical version sturdier, because a commitment holds precisely when a preference would crack. Two witnesses, from opposite ends of history, testifying to the same truth about money. When independent sources with nothing in common arrive at the same answer, it is worth paying close attention. That is not a coincidence. That is a signal. Now, a fair challenge at this stage is this. That is a lovely philosophy, but does it actually work, or does virtue cost you the market? So let me give you the honest numbers. Screen the whole market broadly for values, and you roughly keep pace. A broad ethical screen has tracked close to the S&P 500 while quietly excluding the sectors it will not touch. Keeping your values did not cost you the market. But apply the same discipline with real selectivity through rules-based composites built on these ideas, and the picture gets more interesting. Those systematic baskets have not merely kept pace. Over the same window they have delivered roughly 2 times the return of the S&P, and in the most concentrated case more than 2 times. Not by cherry-picking, but as transparent, rules-based indices with published track records. The point is not to promise those numbers will repeat, because nobody honest can. The point is simpler. Ethical investing, applied with discipline, has as much potential as anything else. Applied well, it can be an edge. None of this is a promise about future returns. What two traditions 14 centuries apart offer you is not a forecast. It is a framework for asking better questions before your money moves. Those questions do not guarantee you will be right. They guarantee that when you are wrong, and you will be, it will not ruin you. If this earned your attention, subscribe so the next one reaches you. The full written piece and the ethical screening tools are linked below at titanprotect.trade. And tell me in the comments. When you avoid a fragile, harmful business, which reason leads for you? Because it loses, or because it is wrong?